Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Financial Institutions, Employee Retention Credit Considerations. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to turn it over to one of today's presenters, Seth Doorn, Senior Manager here at Moss Adams. Seth, the floor is yours.
Hey, thank you. Hi, everyone, and thank you for joining us. Seth Doorn. I'm a senior manager in our state and local tax practice. I'm based out of the Portland office, and I spend most of my time helping clients with state and local tax issues, including multi-state payroll tax issues, and not necessarily federal payroll tax credits, but our SALT group does a lot of credits and incentives work. So when this employee retention credit came out in early 2020, I joined up with several other colleagues to learn about it and help clients navigate the new law, and really mushroomed and become a primary focus for a number of us over the last couple of years. Rightfully so. It's with the right set of facts, it can be a really valuable credit. So that's kind of how I started with this employee retention credit the last couple of years. And Craig, I'll let you introduce yourself.
Thanks, Seth, and thank you everybody for taking the time to join us. We appreciate your time and your focus on this. I'm a senior manager working at Moss Adams, located out of the Dallas practice. I've been working in the credits and incentive space for approximately 20 years, and that spanned the gamut of both federal and state incentives, everything from a tax credit that you receive as right because it's in a statute to you want to move your operations from the West Coast to the Midwest or from the East Coast to the West Coast, and you want to negotiate incentives for that move for your business. That said, I think Seth had a good introduction. The ERC is a program that's probably once in a generation. It is a cash benefit that, if qualified for and can be documented, can be extremely lucrative. I don't know that I've ever seen a demand for a single program quite like this. And so over the last several years, I've spent a lot of time focusing on helping clients qualify, calculating, and then preparing a file for Irs examination that we hope they don't need, but potentially 4 years down the road, having this documentation all put together contemporaneously today will be of tremendous value. So with that, I'll turn it back to Seth, and we'll get right to it.
Okay, thanks. And that brings us to our agenda for the rest of the webinar. First, I will spend some time just talking about the retention credit in general, the eligibility criteria, and how to calculate it, how to claim the credit, and then I will turn it over to Craig for the tough stuff, to talk about what a partial suspension of operations means for financial service companies, the documentation that we would recommend for potential rebuttals against challenges, and then what we're starting to see on Irs Examinations. This is all pretty new, so the examinations are only just beginning, but I have a few comments on that. I think then that leads us to our first polling question, and we just want to get a feel for where everyone is at, the familiarity with this. So how familiar are you with the employee retention credit? A, you looked at it and you've already claimed it. B, looked at it and determined that the financial institution does not qualify credit. Or C, you joined today to make that determination and see if you think your financial institution qualifies. So you'll need to select your answer and then click the submit button. And I think you need these for the CPE credit. We'll give you a minute to do that, and then we'll.
You know, Seth, while people are filling out the poll, you know, while we've talked about the fact that you and I have been involved in this credit for 2 years, I think it's important to note we have seen more and more clients recognizing that they qualify for this benefit. And people, while they, you know, nobody's really new to the table on this, because it just continues to go on, and more businesses identify opportunities to qualify.
Absolutely. And yeah, we'll get into that a little bit more later on, how this has changed over time and up certain instances. So here we have the results. Good. Yeah, a few folks have claimed it, a few have not, and I think that's actually a good result. This is a very fact-specific determination, and so it doesn't necessarily apply to every single business or every single financial institution. You just have to look at those facts, and then that leads to the majority of folks in answer C, who are, you know, looking for some more information to see if they might qualify. And so now I'll get kind of into some of the technical information here on the retention credit. This first slide is just some historical background, but I think it's helpful to understand kind of how this started, how it's been extended a couple of times, and which has led to some changes in the law. So we have kind of one set of rules in 2020, and then another set in one that I'll comment more on later. But this originated from the CARES Act in March of 2020, kind of at the very beginning of the pandemic. It was put together and passed kind of as an emergency act to help shore up businesses and create this refundable credit to offset employment taxes. And it was originally set to go through the end of 2020, 12/31/2020, but then the Consolidated Appropriations Act was passed. I believe that was at the very end, right around the holidays of 2020, that extended it through June 30th, 2021. And then later, the ARPA, American Rescue Plan Act, was passed, and that extended it again through the end of 2021. But then the legislature got cold feet, and in the Infrastructure Investment and Jobs Act, they actually cut that short. So it really ends after Q3 of 2021, where we're at today. There is some discussion of some lobbyists trying to reinstate it. It doesn't seem like that's getting much traction, but it is still a conversation that's going on. And so here's some of the eligibility criteria. We tried to divide this up. Like I mentioned earlier, there were some rule changes under the Consolidated Appropriations Act and ARPA that were effective for 2021. So we kind of have one set of rules for 2020 and another set of rules for 2021. So we tried to divide that into these two columns. And so the first eligibility requirement, and this is really the first thing to look at whenever we're talking about the employee retention credit, is there's a legal term. It's called eligible employer, and the way you meet that eligibility test is in one of two ways. First, if you had a full or partial suspension of operations due to a government order that limited commerce, travel, or group meetings. And so that's criteria number one, and that's the same for 2020 and for 2021. The other test is if your business saw a significant decline in quarterly gross receipts. And in 2020, a significant decline was defined as 50%. And so you would need to see a 50% decline in quarterly gross receipts compared to the same quarter in 2019. And in 2021, that was reduced to a 20% decline. So it became a little bit easier to meet that test for 2021. I just noticed 2021, we say through December 31 at the top of that slide. That would have been under ARPA, but under that investment, the infrastructure bill that passed, that cut that short to Q. So that was one change, an important change that made it easier to qualify or to be eligible. And then, so once you've established one of those eligibility tests, then the next thing to look at is qualified wages that were paid, because the credit then is calculated as a percentage of those qualified wages that were paid while you met that eligibility test. And how you calculate qualified wages depends on the size of the employer. So in 2020, employers with 100 or fewer full-time employees, and that's as measured for the average number of employees during 2019, they can claim the credit on all wages paid to their employees during that. For employers with more than 100 full-time employees, credit only applies to wages paid to employees during the time that they were not providing services. So the idea for the large employers is that if they met one of those eligibility requirements and they had employees who were not working because of that, but they continued to pay them anyway, that's the idea. You could take the credit on those wages that you paid to people even though they weren't working. That third bullet is an important note, and I won't go into too much detail because it's a complicated area, but for employers that are related to other entities, other businesses that are under common control, there are aggregation rules that apply, and so there might be multiple entities that need to be aggregated and treated as one employer for purposes of calculating your number of full-time employees. And so then it's moving over to the second column. Yeah.
Oh no, I'm sorry. Why don't you finish your thought? We've got a couple. When you're complete, we've got a couple good questions in the chat. I want to run past you.
Okay. Yeah, Sure. Yep. I'll just comment on the change that took place in 2021. So that was the employee threshold was actually increased to 500. So now, if you were for Q1, Q2, and Q3 of 2021, if you had fewer than 500 full-time employees, and again, we're looking back to your head count in 2019, pre-pandemic, you could take the credit on all wages paid. And if you're over that 500 employee threshold, then you would have to identify wages that were paid to folks who are not providing services.
And that actually ties in with one of the questions that was being asked, which is, how exactly can we determine which wages were paid to team members who are not providing services?
Yeah, that's a good question, and kind of gets into some of the nuance when you get into the practicality of actually calculating the credit and identifying those qualified wages. I think the most ideal situation is if you set up a separate pay code for employees to use to say, if you didn't have any work to do during our shutdown, just don't have to work, code your time to this generic COVID admin time code or something like that. That's the easiest, because then we can go back and just run a report by that time code to identify those wages. One approach we've taken is to have managers sort of do an assessment of different employees or categories of employees and say, we continued to pay them their full wage, but we know they were only working half time. So in that situation, you could take the credit on the difference, 50%. One thing I'll note there is that the guidance that we have from the IRS, and Craig will talk more about this, it's called Notice 2021-20. They have an example in there that basically says you can't just look at your employee's productivity. So if you still expected your employee to work a full 8-hour day, but they were less productive, you can't make a determination to say that they were only. I think a time code or some sort of management assessment is probably a better basis for identifying those.
Can we sneak in one other clarification? Because I think that this has application to other slides we're going to talk about, which is employee hours being at least 10% of the same quarter in 2019, whether or not that's a function of all operations or just the part that were suspended. I think part of the preview of this is when we start to talk about more than nominal and what that means. The financial institution, could you take a shot at that one as well?
Yeah, that is a tough one, and the guidance we have is a little bit vague, but yeah, I think that's what that question is getting at, is that it needs to be the portion of the business that shut down has to be more than nominal, and IRS has defined that as at least 10%. And you can measure that in terms of gross receipts or in terms of hours worked by your employees. And then there's sort of a third concept in the guidance of a more than nominal effect. But Greg, I think we'll get into more detail in that.
Yep.
And then this slide, once we've established eligibility and identified the qualified wages, the actual calculation of it is fairly straightforward. In 2020, it was 50% of those qualified wages that were paid. There is a maximum limit of $10,000 in qualified wages per employee, and that's for the whole year. And so that results in a maximum total credit of $5,000 per employee. And then in 2021, that was increased to a $10,000 limit per quarter, and the credit was increased to 70%. So that results in a total potential credit of $7,000 per employee per quarter, and for the 3 quarters, $21,000 per employee. So, taking all these things together, these bright line tests kind of create some, I think, unfair results. I guess taking a step back to the employee headcount concept, I had one business that had 105. I think they were barbershops, and they had 105 employees. And he was only paying people who were actually working. He wasn't paying anybody to stay home and not work. And so eligible, because barbershops were hit pretty hard by the pandemic, but didn't have any qualified wages because he was over that 100 employee threshold in 2020, where someone with 99 would have been able to take the credit on paid. So sort of interesting results based on these bright line tests. And the same would go for the 50 or the 20% decline in gross receipts. you're on the wrong side of that, you might. I think just a symptom of the law that was passed kind of quickly and in a situation. Create some interest. So this slide is just kind of on the practical. How do you claim the credit? It's a payroll tax credit, and so it's claimed on the 941. Or if you did not claim it on the original 941, you can go back and amend 941 with the 941X. And it's fully refundable. So make the option to request a check from the IRS or apply it to future payroll tax deposits. And the statute of limitations for amending that 941 and filing the 941X is 3 years from the date of the original return was filed, or 2 years from the date that the taxes were paid. The processing time at the IRS has kind of gone up and down with this. Craig, I don't know if you have any recent experience on how long things are taking. It's several months after you submit that 941X.
I think that's
what you request.
Yes, Seth, I think that's fair. I think from what we've learned from speaking with the service, refund amounts that are over $100,000 receive a second level of review before they're paid. And quite candidly, I would put the time frame much closer to 9 months after the IRS receives an amended 941 before a taxpayer receives a check in the mail. Generally speaking, there's a letter that they'll receive about 3 weeks indicating an overpayment of the payroll tax. And then 3 weeks after they receive that letter is when they'll receive a check. But I think as a general observation, we're benchmarking for our clients 9 months or so before they receive the funds.
And this is another important note. So as the CARES Act was originally written, any business that took a PPP loan could not also take the employee retention credit. And the PPP loan was a better deal. It's fully, fully refundable in the sense that it's fully forgivable. And that was getting all the press when that first came out. So the employee retention credit kind of took a second chair, I think, to the PPP program at the very beginning. But then under the Consolidated Appropriations Act, they actually changed that and said that you could participate in both programs, and they made that retroactive. So at the end of 2020, all of a sudden, the employee retention credit was kind of opened up to everyone, and even if they had taken a PPP loan, that continued into 2021. There is still a prohibition on double dipping in both programs, so you could not take a PPP loan, use that to pay wages, get forgiveness on that loan, and then also take the employee retention credit on those same wages that were paid for with the PPP loan. So kind of interesting, complicates matters. We've helped a number of clients that took a PPP loan. You have to identify those wages. You have to identify the amount of the PPP loan and sort of back out the wages that would have been forgiven for the PPP loan. Still claim the credit on the leftover. And there's similar rules then for a number of other employment tax credits, including WOTC, the Work Opportunity Tax Credit, and then the paid sick, family leave, and medical leave credits. Those are also part of the CARES Act, and again, those were a little more beneficial because they were 100% refundable compared to the 50% or 70% credit that the employee retention credit offers. And then there's also the disaster employee retention credit and research and development credits that again are based on wages, so you can't claim those credits and the employee retention credit on the same dollar of wages. You have to kind of go through the exercise of distinguishing between sets of wages. That brings us to our second polling question. I'll let you handle that one, Craig.
Sure, thanks. So second polling question, did your company suffer a partial suspension of operations due to a government order or have a reduction in gross receipts? Question A, yes, partial suspension. Answer A. Answer B, yes, a gross receipts reduction. Answer C, none of the above, or D, not sure. And I think as we're thinking through this, one of the questions that was asked in the chat, I think pertains to this. And it was sort of if a government order has limited meetings of a certain capacity, does that mean everybody qualifies? And I think one of the themes that Seth and I would want to get across is we don't believe that there is an absolute certainty for total qualifications for all businesses. In fact, I think we would suggest if you come across a theory around qualification that would qualify every business in America for this credit, that's problematic in our eyes because of all of the language that's been written both by Congress and the IRS around qualification. The limitations would have no meaning then. Or alternatively, it's really a facts and circumstances question, and we're going to get into that in later slides. I'm not sure. Okay, so here we go. So it looks like a number of the businesses had a partial suspension. A number of you have had a reduction in gross receipts. A chunk of the financial industry clients here have had none of the above, and a number of you are not sure. And I think the not sure lends itself to a conversation about what your facts and circumstances were and how the business may or may not have qualified under the government orders that we're going to be talking about. So with that, we'll move on to the next slide. All right, so partial suspension considerations for financial services. This, I think it's fair to say, is a bit art and a bit science. It's a bit science because at the end of the day, when Seth and I talk to clients, what we're trying to convey is you have the art, which is the language, which is in the CARES Act, which is in Notice 2120, which provides examples for qualifications that we can analogize to your business. But it's also science in terms of actually sitting down and doing the math to demonstrate the impact to the business as being more than nominal. And we'll talk about that on a different slide. There were 4 notices that were written for the ERC benefit. The one that we're really going to focus on, though, is 2120. And there are 2 particular themes that run consistently through this notice that I think are important to notify, to talk about and to think through. And it is the mere fact that an employer must make a modification to business operations due to a government order doesn't result in a partial suspension unless the modification has a more than nominal effect on the business operations. And we'll talk about what that means in later slides, but I think it's fair to say everyone was impacted to a greater or lesser degree due to COVID and our business operations. But we have to be able to tie a government order to that impact in a way that we can tangibly demonstrate impact of the business. And then the second aspect of this is whether a modification required by a government order has a more than nominal effect on the business operations is based on the facts and circumstances. So we frequently see lists of qualifications that are provided to clients, and there could be 10 different criteria that are provided there. Some criteria are clearly more impactful to a business than others. And what we're suggesting as we work through in documenting and putting together the support to defend one of these claims, that what we're trying to do is look to the facts and circumstances that presents a compelling case for qualification and are not circumstantial. So banks and credit unions were generally viewed and deemed to be essential businesses. Now, that is not a bar to qualification. It just means that there may be a few additional steps that we want to look at and that we want to document for purposes of qualification. Notice 2120 provides that if a government order requires an employer to close its workplace for certain purposes, but the workplace can remain open for limited other purposes, then the employer is considered to have a partial suspension of operations if under the facts and circumstances. And this is where we're going to get into this more than nominal test. A more than nominal portion of the business operations are suspended, or for purposes of the ERC, a portion of the employer's business is considered more than nominal if it's not less than 10% of gross receipts or not less than 10% of the hours of service performed by employees. And the way in which I like to think about the gross receipts test, and all of this, by the way, relates back to 2019. That's the test period. That was a year before COVID. And then in 2020 and 21, when this credit is operational, that's when things sort of went off the rails from a testing standpoint. So what we're trying to do is go back to 2019, look at revenue streams that may have been disrupted as a percentage of gross receipts. So for instance, you could consider things such as when a lobby in a bank is shut down, what activities occurred in that lobby? What revenue streams were generated by physically having employees there? Can we document enough of those revenue streams to exceed 10% of gross receipts in 2019? Alternatively, say we can't, or we can, but we want to go a step further. And remember, it's an or test. You don't have to. But can you identify an impact to the business where 10% of your employee hours were damaged by these government regulations, or suspended, excuse me, that's a more appropriate term. So what type of activities could those be? Could you have, for instance, personal bankers that would normally go and meet with clients? They would take them out to lunch, they would take them out to a sporting activity, they would take them out to dinner. And those hours represented more than 10% of business hours, essentially your marketing activities. Was there a conference that your bank or your credit union would normally attend where you could identify additional leads and develop additional financial benefits for the business? Were those areas impacted? And can we tie back to a certain percentage of revenue related to 2019 that's more than 10%? If we're able to do that, then I think there's an argument to be made that the more than nominal test is passed. And then lastly, one of the other things that we're going to talk about is if a government order has a more than nominal effect on business operations. And that's going to be in Q&A 18 of Notice 2021. So these are some additional considerations that we're going to get to later that may be available. So question 11 really gets to the heart of the essential business question, which is if a government order requires a non-essential business to suspend its operations, but allows an essential business to continue operations, is an essential business considered to have a full or partial suspension of operations due to a government order? So again, this ties back to the slide we were just talking about. What we want to do is we want to determine whether or not there was that more than nominal impact. So an essential business isn't considered to have a full or partial suspensions of operations if the government order allows the employer's operations to remain open. There's going to be another slide that we're going to look at that I think is important to take into consideration, which is even if there is a government order and the business is essentially able to retain comparable operations, there may be an issue and a challenge to whether or not the business was really fully or partially suspended. But there are some examples that we can point to that we think, if the facts are fleshed out sufficiently, that there may be a way to qualify a financial institution. So for instance, a bank or a credit union, if there was a closure of a lobby by government order, if for instance there were social distancing requirements, and when the bank had someone come in who may have been an engineer or did a study, they basically said, you physically can't operate your facility because there isn't enough room to comply with the government order. Documentation of that type would be helpful for purposes of qualifications. Again, as I mentioned on a prior slide, the example of the personal bankers, people who The relationship is critically important. You just can't have the same type of relationship and develop the same type of business over a Zoom or a Teams call compared to taking your clients out and having that in-person contact with them. That's what we're looking for. Another polling question: was more than a nominal portion of your business operations suspended by a government order? Answer A, yes. Answer B, no. Answer C, not sure. Or D, we need help determining if more than a nominal portion of our business was suspended. We'll give just a moment for those to come through.
And Craig, is this a good chance to kind of go back to that polling question that you brought up about the employee hours? What's the rule about employee hours being at least 10% from the same quarter in 2019? Is that in total or a function of suspended operations?
So I think what we're looking for is likely in total. That being said, I think what we're also doing as we're putting together a file for purposes of qualification is we're looking at the totality of all the facts and circumstances to build a case. And assuming that we're able to point to different areas where the business may have a good fact pattern to qualify, the more of these that we can put together, I think the more comfortable the financial institution should feel about how they'll be able to support their claim.
Yep, right. But the idea there is to show that the number of hours that have been, I guess I should say, the number of hours worked by employees that have been suspended by government orders is 10% of the total.
That's correct, yes, directly. And so this is, I think, not surprising that given the fact that financial institutions were essential businesses, in many instances, we're not going to see a more than nominal portion of the business suspended. That being said, there can be different states with different government orders that were more restrictive, where you can point to the fact that the business was suspended in a more than nominal way. And then there are a whole bunch, about a third of all of you, 40% of everybody, who it's not entirely clear. And I think if it was crystal clear and there was one bright line that either qualified or disqualified everybody, we would want to take a look at that and make sure that we agreed with that final conclusion, because we think there's a lot of nuance here, and it's a pretty complicated question. All right. So Seth, I think you were going to handle question 14.
Yeah, I'll talk through this one. And so again, these are actual questions and answers out of that Notice 2021-20, which is really the best guidance that we have from the IRS on how they're going to look at these. And not everything is directly analogous to banks and credit unions and financial institutions, but they kind of give us some themes and at least some idea of how the IRS is going to look at this and treat these. And so question 14 says, if an employer voluntarily suspends operation of a trade or business or voluntarily reduces hours due to COVID-19, but the suspension or reduction in hours is not due to a governmental order, may the employer qualify as an eligible employer solely based on the voluntary suspension or reduction in hours? The IRS answers that no. An employer that voluntarily suspends operations of a trade or business or voluntarily reduces hours due to COVID-19 is not eligible for the employee retention credit based on a fuller suspension of its operations. And so what this indicates to us is that we really need to be able to tie the suspension of operations to a specific government order, and that can be federal, state, or local. And so that takes a bit of research to identify the orders that are out there and that may have been impacting the business, and then again tie that to the specific facts and how that impacted operations. And so, and I think we saw this from a number of businesses, is that kind of out of an abundance of caution for their employees and customers, and well, that's a good thing. It may not have been the direct result of a government order, so just want to be able to tie those things together more closely.
Hey, Seth, a question came through, which is we were leasing office space in a building, or we're leasing space in an office building, and told by our landlord that we could not access the property initially, and this was back in March of 20, and then we're only allowed to have limited capacity at a later date. Will that qualify us?
Yeah, interesting one. You know, I hate to say this, but I think it depends, right? And we'd want to look at whether that was the landlord being just cautious and wanted to limit people in the building, or was there actually a government order that they were relying on, and that we could, you know, go back to the landlord, we could research the government orders that might have been in place to make that determination. But again, we'd want to tie it to a specific government order, and it might depend on the specific facts. Is that a location where you served customers? I think that would be a good fact. Or is it just back office space that you were leasing, and you just sent all of those people home, and they worked from home then remotely? And that'll get into one of the next Q&As. So yeah, again, I think just have to look at those specific facts and the specific government orders that could have been in place there. Question. So I'll hand it back to you for question 15.
Sure. If a government order requires an employer to close its workplace, but the employer can continue operations in a comparable manner to prior to the closure by requiring employees to telework, is the employer considered to have suspended operations? And this is one of the things where I think we want to look at the totality of the facts and circumstances for the business to put together a position that would support the closure and address whether or not the business could operate in a comparable way. So, for instance, the answer to the question is no. If you can continue your operations in a comparable manner prior to the closure, then you're not considered fully or partially suspended. So when we think about this, we think about, could the bank shift to online transactions? What about using ATMs, mail, the telephone, drive-up service? Are you able to do things in a similar way than you were previously able to? You know, but on the other hand, what activities were previously done in person that you can't now do in person? Can I access that safe deposit box through the computer? No, I can't. Obviously, I have to be there in person. But when you look at examples like that, are those activities, do they, in the aggregate, end up constituting an effect on the business that is more than nominal? It may very well be that a percentage of your customers were not able to access your safe deposit boxes. But if that part of the business is de minimis, it may not be enough to get you there. And again, I think this last bullet point, what documentation can the bank develop which demonstrates an inability to conduct comparable activities, is important. On the one hand, you can, qualify yourself, but you want to be prepared should that IRS examination come to be able to address the counter arguments as well. So with that, we will move on to question 16.
Yeah, and this one is sort of related to the comparable operations. So question 16 says, what factors should be considered in determining if an employer is able to continue operations comparable to its operations prior to closure, such that the employer's operations aren't considered to have been fully or partially suspended due to a government order? And then the IRS lists a few of these factors to look at. Did employees have the ability to telework? Could they bring their work with them home to a remote environment? Or was the employee's physical presence required in the workspace in order to do the job? And then what about transitioning to telework operations? And so those are just some factors that the IRS suggests you would have to look at. And you know, I think in the answer, and I don't know that we capture this in the column to the right, but it kind of leaves open this area for a transition to remote work. So maybe you did not have those capabilities before you were shut down, and so there was sort of a ramp-up period where you adopted the technology for people to work remote. But then after that, you were able to continue your operations in a comparable manner. So there could be kind of a interim period where you were ramping up. And so, it's a fact-specific analysis, and it can get complicated, but those are some of the things we would want to look at to determine if you were able to continue comparable operations or not.
And Seth, if I can just add, and this sort of jumps ahead to, at the very end of the presentation, we go through what we've seen on Irs Examinations so far. The IRS has 5 years right now to do an exam on these claims. And we think putting together the documentation today to rebut potential avenues of disqualification is critically important. And we'll get into that more, I think, at the end of the presentation. But I think it's important, in addition to thinking about qualification, thinking about particularly this question and a couple others, how the business can put together a file today to ensure in 3 years or 5 years, whenever that may be, that they've documented things in a way to address potential avenues of approach by the IRS.
And I'll let you continue, Craig, on 17 then.
Sure. So if a government order requires an employer to close its workplace for certain purposes, but the workplace may remain operational for other limited purposes, is the employer considered to have a suspension of operations due to the government order? And I think that this is one of the areas where this is why, and I addressed a question that was in the chat that I thought was a good question, where we don't necessarily believe this is an everybody qualifies or no one qualifies situation. It really gets back to the fact that this is subjective, that it really depends on the facts and the circumstances and the issues around what are we able to document that shows a connection between a government order that impacts the business and that it be more than nominal. I think if a memo is prepared for documentation purposes and it simply lists here's the impact and here's the order, and we never get to, but this is how that order impacted the business in a more than nominal way, I think there's an opportunity that years from now, that may not be viewed as sufficient for purposes of documenting qualification. And to address one of the questions in the chat, isn't 5 years beyond the statute of limitations if the returns are filed every year? Apparently, when this act was passed, the IRS was given 5 years for the statute of limitations.
And Greg, I actually haven't looked at this recently, but was the 5-year statute only for Q3 of 21 when they, under ARPA? That might be something we can check back on, because the standard statute is 3 years, but they did extend it at least for some of the quarters to go back and audit these.
That is correct. All right, and so moving along.
We're about at 50 minutes, so maybe I'll go over this one quickly so you can hit your last few slides, Craig. But
sure.
Question 18 from Notice 21-20 is what factors should be considered to determine whether a modification required by a government order has a more than nominal effect on the business operations. And this is just, I think, to Craig's points, becomes kind of a vague issue and requires some development of the facts to document that the effect on the business was more than nominal. And again, the IRS defines that as a 10% in your ability to serve customers or sell your goods, I believe. And so some good examples that the IRS provides is limiting occupancy, requiring services to be performed only on an appointment basis, change the format of the service, for example, restrictions on buffets and self-serve. And then this is kind of an interesting one. You know, on the one hand, they say requiring employees and customers to wear face coverings is the type of modification that's contemplated under QA 17, but then later on in the answer, they say that requiring a face mask would not have a more than nominal effect on the business. And I think that's right. I think, you know, as we all experienced, you could still go about your business with a mask on, however much you liked it or disliked it. The business could still operate even if masks were required. So it's kind of funny that they say on one hand it's the type of modification that's contemplated, but then on the other hand they say it would not have a more than nominal effect on the business. But you handle 20 there, Craig.
Yeah. So is an employer that operates a trade or business in multiple locations and is subject to government orders requiring full or partial suspension of its operations in some jurisdictions, but not in others, considered to have a partial suspension of operations? And so the IRS gives an interesting answer, which is employers that operate a trade or business in multiple locations are subject to state and local government orders requiring full or partial suspension of operations in some, but not all jurisdictions, are considered to have a partial suspension of operations. So consider the juxtaposition of a business that has operations in California, which arguably had a series of restrictions, versus the same business operating in Florida with just different locations. And arguably speaking, Florida either did not have restrictions or did not have restrictions to the level that California did. So when we look at this, what we're trying to determine is, is the government order requiring the closure of locations in certain jurisdictions but not in others? So yes, we have that fact of the California and the Florida examples. May an establishment have or establish a consistent policy that complies with local government orders, though the employer may not be subject to governmental orders to suspend the operation of its trade or business in certain jurisdictions? So again, that employer may have restrictions in California, and we would be looking to see, did they have similar restrictions in Florida, where arguably speaking you don't have the same government suspension of operations or limitations. So ultimately, the business is still considered to be partially suspended in its operations due to the government orders requiring the closure of some operations in some jurisdictions but not others. So what that means at the end of the day is, with a consistent policy between how your operations were in California with limitations to how they operated in Florida without, under the theory of this government suspension, even though you didn't have suspended operations similarly in Florida, because they were treated similarly and you had a consistent policy, you could take the position that the entire business was suspended or partially suspended as a result of those government orders. All right, IRS examinations. I would say 3 or 4 months ago, we had not seen any of these. We are starting to see the IRS sending out notices to clients and examining the claims they filed. And so, of course, the big question is, well, what are they asking for? Let's talk about the areas of initial focus. Documentation that the taxpayer is an eligible employer for purposes of the credit, based either on a significant decline in gross receipts or a full or partial suspension of operations. So that's why I think we've hit the theme a couple times. Documenting today is going to be very important. If the IRS is going to examine you or 3 or 4 years from now, arguably speaking, tax departments are going to turn over, providers are going to turn over that filed these claims in terms of the personnel. Institutional knowledge is going to be lost. I think we're seeing for a lot of the government orders that were put online, they're starting to disappear from state websites, local websites as well. You certainly can file an information request to obtain copies of those suspension orders, but we're seeing difficulty in certain instances in obtaining them. Documentation on the number of full-time employees. Doing that calculation gets back to Seth's point about were you over or under 100 employees for 2020 or 500 employees, all related back to the 2019 period. Getting that done now while you have access to that information is very important because you don't want to find yourself on the other side of being a large employer when you believed you were a small employer. Documentation of the calculation of the credit itself. Arguably speaking, there's not a tremendous amount of skill in the calculation of the credit. It really does go to the underlying qualification. But making sure that you're doing things around, for instance, the interplay with PPP, which is the last point, is critically important to do today so that you have all of this in your file for several years from now, taking into consideration those other federal wage-based credits. Having it all in one place so it's easily accessible is going to be important. And then lastly, not exactly the last bullet point because we talked about PPP, but documentation of aggregation and how the aggregation impacted the qualification and allocation of the credit. I think we touched on it briefly, but if you have to aggregate businesses, there may be additional gross receipts that you have to take into consideration, and that presents opportunities. It presents both opportunities for other parts of a business to qualify that you might not have initially considered. It also presents a risk that by adding in those gross receipts, it might disqualify the business. Having that analysis done today is very important. The other side of that aggregation question is one around headcount. A business that is required to aggregate employees from another business because of ownership may find that it has more employees than it thought it had and may be considered a large employer and not a small employer. So going through and documenting all of these factors today, we think is critically important to file a claim that will withstand IRS examination. And also, when your third-party auditor comes through and they want to take a look at your financial statements, having all of this ready today is going to avoid potentially significant headaches down the road for the business. And with that, Amy, I think I will throw it back to you to close out. Oh, one more polling question. So
yeah,
here we go. Oh, sorry. Do you believe your business qualifies for the ERC? Yes, and we have filed a claim. Answer number A. Answer B, yes, but we have yet to file a claim. Or C, no, after this presentation, we don't believe we qualify to claim the ERC. Just give a minute. All right, and there you have it.
All right, thank you. So unfortunately, we are at time, so I am going to close us out here. But thank you, Seth and Craig, for a great presentation today. And also thank you to our audience for submitting your questions to help guide today's conversation. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have additional questions. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have difficulty downloading it now. And then also, as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.